A lot of our entrepreneurs say, well, I'm never going to retire. Why would I want some retirement plans? Or that's what the W-2 employees use, retirement plans. We both don't think any entrepreneur should live or die by these retirement plans, but I do think they belong in every single entrepreneur's tax plan as a diversifying bucket and a diversifying tax bucket in particular.
You get rich by being concentrated, you stay rich by being diversified.
Right.
And generally people get rich by being concentrated in a small business.
There hasn't been as many practical use cases as I think people thought 3 or 4 years ago. So to me, the narrative has changed a little bit that crypto is more of a store of value and a diversifier, and it's really only worth something as long as everyone thinks it's worth something.
People actually investing in it and understanding it and being aware of it is relatively recent. So I would caution people from making too many conclusions about how this is going to work in your portfolio versus, real estate and stocks or something like that we have incredibly long track records on.
Welcome back, Jim. We've got episode 4 of the Make Rich Real podcast, where million-dollar businesses meet billionaire strategies. How are you feeling today?
I'm feeling good. And our last podcast, you gave me a hard time about dressing casual, so I threw a jacket on today.
Yeah, you look good. That? Thank you. I appreciate that.
You remember when you first started working for us when we hired you and we wore ties every day?
Yeah.
And then after like 6 months, you said, I feel stupid. All our clients are entrepreneurs, and I'm wearing a tie. No one wears a tie.
Yeah.
And then we got rid of ties.
Yeah.
And now you're giving me a hard time for dressing too casual.
Times change.
The world, everything comes
Full
around.
circle. Full circle.
All right.
Things do come full rise. All right. We're going to talk about crypto's rise. Having a great year this year. We're going to talk about crypto as an asset class and Bitcoin. We're going to talk a little bit more about the deficit. We're going to solve some problems today. We're going to fix the government and their financial situation. You excited?
I wish we could do that, but yeah, I'm excited to talk about it.
Well, then we're going to go against how we're going to fix it, because we're also going to talk about entrepreneurs and how they can save more money by reducing their taxes, which is not going to help our government fix their fiscal situation.
But it'll help because then they'll economically drive the...
Exactly.
Yeah. So
byproducts there.
Yeah.
Okay. Well, let's talk through the briefing room here. Let's talk through Bitcoin. It's up over 13% this year. It depends on when people are seeing this, in the ballpark of probably 105, 120 grand, 107,000 or so today, and was topped out around 118, 120,000 dollars. So first chart I want to put up here, Jim, as you scroll down there a little bit, is Bitcoin performance versus other asset classes over the last 13 years. And so what different people are seeing here is every single color on this table represents a different asset class. And so what's interesting is your eyes instantly are pulled to, well, that gold is either at the top or at the bottom, and that is Bitcoin. So last year, Bitcoin did about 120%. The year before that, 159%. But the year before that, it was down about 64%. So, and it looks like Bitcoin kind of every 4 years goes down about 60 to 75%, and then it rips back higher. So if that's the case, then maybe 2027, 2028, it's going to go down 67%.
Yeah, one thing people need to understand the mathematics is if you lose 50% of an investment, you don't need just 50 to get back to even. You need 100% to get back to even. So the downs hurt you more than the ups help you. But yeah, Bitcoin has had some incredible years, that's for sure.
Yeah. All right, let's talk about this within the context of asset allocation. So Bitcoin has, whether people like it or not, it is an established bona fide asset class, especially over the last 2, 3, 4 years. And with the current administration and White House and the crypto czar, David Sachs, providing a legal framework around this and some of the new laws coming into place, I think we're only going to see more tokenization, more crypto, more blockchain, which I think is good overall. And Bitcoin seems to be a benefactor of that. But I pulled some data here from Crypto Asset Management, XBTO is the source, and it said 74% of investment professionals have invested in cryptocurrencies, so that's a decent amount. And it says 86% of billion-dollar plus single-family offices are considering crypto since the presidential election. So I think they're seeing Trump legitimatizing this. There's a legal framework, and it looks like now billionaire family offices are actually starting to build a stake in here. I just saw that Harvard just built a stake, a 9-figure stake in their endowment. But it does say that average family office crypto allocations remains about 1 to 2% of the total portfolio within that alternative bucket. So what are your thoughts on ultra high net worth, billionaire family offices, fractional family offices, what we do, allocating towards crypto and Bitcoin? Well,
I know I personally allocate toward this area a little bit, but a little bit is the key. And I think just like any asset class, you don't want to be over-concentrated. And like you've heard me say many times, you get rich by being concentrated, you stay rich by being diversified.
Right.
And generally, people get rich by being concentrated in a small business. There are, I'm sure, people who've gotten rich in cryptocurrency, but those are very few. There are a lot of people who've lost their entire lives savings to crypto as well. Crypto still I put in the category of speculative. Why do I say that? Because the only reason you buy crypto is because you think it's going to go up in value. The only reason you sell it is because you think it's going to go down in value. Now, you might be listening and think, well, isn't that every investment I make? Well, no, because unlike if you buy, let's say, Apple has buildings, employees, products, a pipeline of new products. They have intrinsic value. They have cash on the balance sheet, huge, more than the GDP of small countries. And I'm not promoting Apple stock. I'm just saying that you would buy Apple stock, yes, because you think it's going to go up in value, but also because it has this intrinsic value. It's got all these things that you know are valuable within this company. With crypto, there is none of that. It's not like they have cash reserves or employees or products or anything else. And so for that reason, it's in the speculative phase. Will it ever go out of that in some way? Possibly. But I do believe it's a diversifier. I do believe it's something that can make great returns, as you've shown in your portfolio. You just want to make sure that you're investing the amount that you can afford to lose and that you have that balance throughout your portfolio and are not too concentrated in that area.
Yeah, and I know we're talking about Bitcoin in particular, which is like there's really no economic use of Bitcoin besides the medium of exchange. Now there's Ethereum and there's others that are essentially, the rails for the crypto. So that could change with blockchain technology and other stuff, and we'll see where the future goes. But there hasn't been as many practical use cases as I think people thought 3 or 4 years ago. So to me, the narrative has changed a little bit that crypto is more of a store of value and a diversifier, and it's really only worth something as long as everyone thinks it's worth something. And gold actually has probably even more applications than crypto, but there's the same argument against gold, but it's used in some machinery, mechanical stuff, and jewelry. But still, it's more of like people just think it's valuable, so therefore it's valuable.
That's exactly right. And what's interesting about crypto being called a currency, it really doesn't function as a currency. Maybe it will one day. And I know there's some third world countries where it actually functions as a currency. But in general, you and I are not going to go to the grocery store and use Bitcoin to buy our groceries. It's not really working as a currency. And by the way, if it ever works as a currency, this buying and holding will go away as far as a way to make money. And what I mean by that is if I bought a bunch of euros and just held them, in 10 years, would I have if I bought $100,000 worth of euros, in 10 years, I still have $100,000 worth of euros. But if I buy $100,000 worth of Bitcoin, I could have $1 million of Bitcoin in 10 years. That's not how currencies work, because currencies move against each other. So if I'm going to make money in true currencies, I'd have to buy euro when it's cheap, and then as it goes up in value, I'm going to sell it and exchange it for, let's say, US dollars. So it's exchanging the currencies, because if one currency gets too strong, then the cost of goods and services changes, and then money starts moving the other way and then moves that currency in the other direction. That doesn't happen with Bitcoin. It can go up and up and up, and that's why it really doesn't function as a currency.
I think there's a lot of stuff that we could attack in what you just said, but I'm just gonna let it all go because to keep this thing going, I don't disagree with the thesis of what you're saying right there, but I do want to talk through digital gold. And so I think that's the thesis that if you are allocating capital to Bitcoin, let's just say as an asset class, I think the thesis is, hey, this is like a digital version of gold, and it's going to take market share from gold, or maybe increase the TAM of an uncorrelated asset class from gold. And then the next chart that I put together here, or that I found, I should say, is the correlation matrix, which really just shows, okay, hey, if something goes up 1%, how does it tend, or how do these other asset classes tend to do? So for example, if Bitcoin goes up 1%, the correlation of the S&P 500 is 0.55%, meaning that they tend to flow about, like the S&P 500 tends to move about 50% of whatever Bitcoin does, whether it's up or down. The correlation of gold is 0.16%. So actually Bitcoin and gold are really not that correlated. But then if we looked at this, which isn't in the chart here of the NASDAQ or the QQQs, the correlation between Bitcoin and the Qs is actually a lot higher, meaning that when Bitcoin tends to go up or the NASDAQ tends to go up, the other tends to closely follow. So what are your thoughts on that? I think part of the thesis here is potentially a hedge against the current, I'd say, currency system and the Federal Reserve. There's kind of that angle. There's also the, hey, this is an uncorrelated asset class angle, kind of like what gold has served as the thesis for a lot of investor portfolios. Where do you think this is coming into play?
Yeah, I do think there's a diversification piece on this with cryptocurrency and Bitcoin in particular. One thing I will say, though, is what I see a lot of very smart people doing is they compare Bitcoin to things that have been around for 100 years. And Bitcoin is such a new thing, it's really hard to know how these correlations are going to actually match up. If there was everything falls apart, does Bitcoin fall apart, or is it up while everything else is down? And making too much of a read on the short lifetime of Bitcoin. And really, if you go back to when Bitcoin started, it really has come into play in more recent years. Even though there's a longer track record of it being around, people actually investing in it and understanding it and being aware of it is relatively recent. So I would caution people from making too many conclusions about how this is going to work in your portfolio versus, real estate and stocks or something like that we have incredibly long track records on.
I guess the pushback there, though, is that Bitcoin does trade 24/7. Stock market, as an example, is only trading during the day. So although I agree from a timeline, I think it's 2011, so maybe only 14 years or 13 years there. But right, from if you were to zoom out of actual trading time, it's actually a lot longer in terms of the data than just 13 years.
Well, I guess that's true, but 13 years versus 120 or 150 years.
I agree. But trading 40 hours a week for the stock market versus 24/7, I think there's a lot more data as well. I agree with you overall.
Yeah, I just thinking, what have we really seen as far as, we saw the COVID time. What have we really seen as far as dramatic economic times where asset classes act in strange ways?
Yeah.
We haven't seen a lot of those with Bitcoin, but I'm not disagreeing with you as far as Bitcoin can be a good diversifier. And like I said, I've got money in Bitcoin and Ethereum primarily and some other stuff, but I'm kind of, not that I'm a billionaire family office, but I'm kind of like the billionaire family offices that I don't have a large percentage. And we see entrepreneurs that'll have, 50% of their money in Bitcoin. And that you just got to be careful, because then you're talking about that could make you rich or that could make you poor. And it's really hard to predict where this is going, in my opinion.
Yeah, I'm with you. I'm just over 1% of my total allocation as well in cryptocurrencies. And I think when we're seeing the parameters of like that 1 to 3%, 1 to 5%, I think for some folks who want to get some exposure, maybe buying the Bitcoin, the Ethereum, the biggest kind of by market capitalization coins, it's just a way for them to get some exposure, ride the asset class up. But to your point, when there's these halving cycles that have happened in the past, you're not losing, if you have 50% of your allocation in crypto and then you have a halving cycle, you just lost a quarter of your net worth. And it can happen really fast, which for some people, if they're in it for the long game, it can work. But it's if it's a substantial amount of money, it's sometimes hard emotionally to recover from seeing that many red dollar signs on your computer screen.
Yeah, when I see some of these drops, like some of the down years with Bitcoin and how dramatic it is, how volatile it can be, when I see an asset class like that I want to invest in, I especially like dollar cost averaging, which is putting the same amount of money each period of time, whether it's every 2 weeks or every month or every week, but the same dollar amount with the same time frame over and over and over in that investment. And that's what I do with Bitcoin and Ethereum. I put money in every single month, and then when prices drop, I get more. When prices go up, I get less. And over time, that helps me, at least mentally and emotionally, work through the volatility of something like a cryptocurrency.
Yeah, nope, I hear you on that. All right, well, let's transition here into a topic we slightly touched on in our last conversation. We talked about interest rates and the interest rate environment, the market intelligence segment here. Yeah, I want to talk through Treasury Secretary Bessent's 333 plan that he rolled out as part of the administration here. And I just read Ray Dalio's most recent book, and it really was talking a lot about debt cycles and why nations go broke. And so I want to dive into this a little bit. And what I've seen is that there is a theme of 3% of GDP being a sustainable deficit, meaning that we can run, meaning our revenue can be less than our expenses. And as a percentage of our GDP, that can be about 3%. Now, today, we're at 6.5%, so we're more than double that. But Scott Bessent's 333 plan, the first 3% was we need to get our deficit down to 3% of GDP. So how do you do this? Well, there's 3 different ways, and we're going to talk through that. Second thing is we need to boost GDP growth by 3%, and then increase U.S. energy production to 3 million barrels per day. And so increasing the amount of energy output in oil would decrease energy costs. That helps with the boom with the demand we're seeing for energy with AI, and also just help overall inflation stay tame. GDP growth, it's like if you're got a bunch of credit card debt as an example, well, you can pay the credit card bills off, which is one way, or you can just make a bunch more money, and that makes it a lot easier. So if the GDP grows faster, that makes it a little bit more palatable to pay stuff off. And then as we talk through cutting the deficit to 3% of GDP, that's the hard part, is that actually making cuts. Our government doesn't seem keen on making any cuts. So you can also grow your way out of the deficit if you can kind of keep your expenditures the same, but grow your revenue or your GDP here.
Yeah, I heard an economist speak in the 1990s, and he said that based on where we were in the 1970s, with the oil embargo, with inflation at 18%, and the stuff that went on in the 70s, he said if you would have told him at that point that we'd be sitting where we are in the 1990s, he would have said impossible. And how did we get there? We grew. Yeah. We grew to there.
Yep.
But what happened was we had for the first time a surplus in the government. And what did we do? We spent.
Of course.
Right. And the challenge with the government is when you have a surplus, you can't spend the surplus. Right. And you have to somehow quit, and reduce the spending. So I think this is really interesting. And I think this is a better plan than what I see the government even talking about. The question is, can we actually get this executed?
Yes, that's a good question. And even the tariff revenue, right, which it's on pace to do over $500 billion already this year. And who knows, we'll see how all this stuff shakes out in the courts. But to your point, it's, ideally that tariff revenue then goes retire some debt. I would not be shocked if all of a sudden Congress says, we got more money to spend, boys.
I know.
We'll see what happens.
All right. The one thing, I'm actually reading the John Adams biography right now, and it's interesting that the one thing that I think we left out of the idea that became the United States of America was having a independent part of the government that audits the financial part of the government, that holds the government financially accountable. And they didn't put that in there. And that's why, because if you had someone that could audit the government and hold them financially accountable, we would not be where we are today. It's been way out of control.
Well, I think there is something that does audit the government, because I know I've read about how the Pentagon has failed every audit for the last 10 years. So there is some sort of faction within the government that's supposed to be auditing stuff.
But there's no power.
Yeah, it's true. They just
to say, for example, like in our business, if someone in our business comes to us and says, I want to spend this much money on this one thing, we're going to go, show me how that makes any sense. And then we're going to go, no, you can't get this done for 50% of that. Right. Or where's the money going, and make sure that people aren't wasting it. There's no part of the government that can hold them accountable that way. The way that we get audited by the IRS, right? We get audited by the IRS. The IRS can say, no, that's not how it works. Yeah. Right. But there's no component of the government that has any actual authority to limit the spending. Or even if they would have, in the beginning in the Constitution, said there's only so much that you can spend as a percentage of GDP. Yeah, well, I don't think in 1776 they had the foresight. They didn't have the foresight. Try to balance the budget. They did pretty good. But also the other issue with what you're saying, though, is then is it a non-elected party or non-elected individuals can now tell Congress what they can and cannot do, who are elected officials? Well, so then who ends up controlling it are these bean counters? Yeah, well, I think we could easily get on a tangent on this. And if I had to say who, I would just say it should be me for a while. And then once we get things in a better place, then I'd turn it back over to the U.S. government. Okay. Would you do it for free? I would do it for free. I care that much about this country. You are a civil servant. Thank you, sir. Well, let's talk through Ray Dalio's big debt crisis framework here. So he, similarly to Scott Besson, says 3% of GDP is kind of the holy grail of where we need to get. So again, deficits divided by GDP, get down to 3%. We're at 6%, so we're not doing very good. We're 6.5%. It's bad. And so let's talk through the three different ways that you do this. The first way is you can obviously increase tax revenue. If you increase tax revenue, we talked about tariffs, increase tax rates, close tax loopholes, whatever it is. That's one way you could increase revenue. And if you have more revenue, that is going to decrease your deficit. Second option is you can cut spending. It's kind of common sense. Instead of spending so much money, we can just cut spending, which that's, obviously I think we all know that Congress is allergic to that. The third thing is interest rates. And so this all ties back to interest rates. We talked about interest rates last week. Yep. But interest rates is a huge factor in driving this. And I have a chart in here that shows our average interest rate from 1995 to 2024 on these 10-year notes was 3.7%. This year we're at 4.2 is the average, and you can see over time it's projected to actually come down a little bit. So the CBO
is projecting interest rates to come down a little bit, which is good news. But this also, I think, is part of why we're seeing Trump really call for massive decreases in the interest rates, because that helps this budget issue, because we're outlaying over $1 trillion a year on our interest expenses. It's in line kind of with our defense spending, our entitlements to Medicare, Medicaid. So it's becoming a huge piece of the budget is going out the door to interest. And obviously Congress doesn't like it. If they can't control where that $1 trillion goes, they'd love to go spend on other stuff. But the interest rates is a big thing. So how would you fix this problem, right? Increase revenue, decrease expenses, interest rates. How, you're doing this for free, obviously.
Yeah.
How are you going to do this?
Well, one thing that I think it's kind of mentioned there in cut expenses, but also I would say more efficient where we're spending our money.
Doge.
I believe that there's, Doge, I love the idea. And I told my friends who were so on fire about that, I said, this is one of the biggest bureaucracies in the world. And there's so many people that benefit from the way things are. It's going to be really hard to shake it up. But I just believe there's a lot of government waste.
Yeah.
And a lot of our taxpayer money is getting wasted. And no one that I know of is really sharpening their pencil and trying to make sure that people aren't overspending. And, I have friends that work for big companies that get their primary revenue from the government, and they say that every year they just mark stuff up 20 or 30% and the government just pays it. Like no one's in there negotiating and fighting for us, for the taxpayers. And I also know people who've worked for the government that they say that they have to spend their budgets because they're afraid if they don't, then they'll get a part cut for the next year. So there's a lot of stuff that's not set up very well. And I also think there's a big problem in Congress, and that's because typically what happens is if you get elected from one state, I get elected from another state, we kind of go behind closed doors and go, hey, make sure you get my spending through, I'll get your spending through.
Yep.
Because really we don't benefit from cutting spending. We don't get reelected by cutting spending. People are more worried about, do I still get what I get? Do I get what I want from the government? And if you're not going to get me what I want, then I'm going to vote you out of office. So there's no incentive really in Congress for them to say, hey, let's all get together and cut expenses and make this more efficient. So that's where I would go. Because the problem is when you cut taxes, you also, when you increase taxes, you also hurt the economy. And you take the money out of the hands of, our entrepreneurs who are what drive the economy. And you and I, had we, through our business, had less taxes, we would have hired more people and grown faster. Mm-hmm. And that would have helped the economy. Yeah. So that's where the rub on increasing taxes. But you know how I feel about taxes.
Well, I wonder where this is going to actually start changing. And I think that for me, maybe it comes to a point where, like you said, people keep getting reelected because they're just trying to bring the pork back to their constituents, which that's the incentive structure for them. Yep. But as the deficit keeps staying higher, when the market, which we're already seeing some different global Federal Reserve or global, I should say, asset managers are kind of selling off on the dollar, going more towards gold. If interest rates stay higher for longer, mortgages are more expensive. Credit card debt, like all of this, auto loans, all of this is more expensive. If that stays higher for longer, and there's a direct correlation to our federal deficit and debt, and it's because of these elected officials are not cutting, then eventually maybe that's what actually inspires people to hold these elected officials accountable. So I don't know if there's that clear of a correlation yet, but I think that's where I could see something maybe finally changing, because right now it's like, Rand Paul, we have very few people who are running or being able to get actually elected saying, hey, we need to balance this budget out. We got to get this figured out, because everyone's just like, well, what's in it for me?
Yeah, I think that's a great thought, but I think the problem is the average voter isn't smart enough to put those things together the way you just explained. Yeah. And they've got whoever is running against the other person who's going to try to muddy the water. So I think that clear understanding is going to be hard to get, especially when you have ever seen, when the person goes out on the street and asks people like, who's the vice president or who's on the Supreme Court, and they can't answer when they show pictures, but then they show like Donald Duck or Mickey Mouse, and they know all this stuff that doesn't matter, but they don't know the stuff about the government. So I wish people would understand that, but I don't think that's coming anytime soon. So yeah, I am concerned. And one thing that we also have to see as a scenario is there's the scenario and where there's this big collapse and this huge problem. And then there's the other scenario where it's just an economic headwind for decade after decade after decade. Yep. Because for sure, this much debt is going to slow down our economic growth the same way it's going to slow down growth in Europe and China and Japan and other areas, because most countries in the world do have debt, too much debt.
Yeah. All right, let's transition to the Billionaire Playbook. So we're going to talk through retirement plans. Or this is also a big thing that a lot of our entrepreneurs say, well, I'm never going to retire. Why would I want some retirement plans? Or that's what the W-2 employees use, retirement plans. And also, well, you just talked, Bryce, about all this deficit and debt. The government's going to come for my money. They're going to increase taxes. Maybe they're right. Maybe they're wrong. But let's talk through, I think you and I are both on the same page on this, of that we both don't think any entrepreneur should live or die by these retirement plans. But I do think they belong in every single entrepreneur's tax plan as a diversifying bucket, and a diversifying tax bucket in particular.
I agree. Can I make one comment on our tax bracket's going to go up or down?
Yeah, please do.
Because I think I have the answer to that.
Yes.
Yes, they're going to go up. Yes, they're going to go down. And if we just look at what's happened, because this has been an argument that I've heard, especially from like people who love to sell life insurance.
Yep.
And by the way, life insurance is a tool that used appropriately can be really great. And also it's a tool that pays high commissions, and a lot of people are trying to sell it when it's not always appropriate. And I saw this from insurance salesmen and from other people who would say, hey, why would you ever want to defer any taxes? Because tax brackets have to go up. Look at the deficit and the debt and all the things that we've just been talking about. There's no way the government needs more money. They're going to have to increase taxes. But guess what's really happened? Because we've had this deficit and debt problem for a long time, multiple decades. And if you think about it, what happened? Taxes went up under Bill Clinton. They went down under George W. Bush. They went up under Obama. They went down under Trump.
Yep.
Right? So they've gone up and down depending on who was in office and who controlled Congress. And that's what's going to continue to happen. Someone gets in office, they control Congress, they raise taxes. Someone else gets in it, people are mad because they're paying taxes they didn't want to pay, then they lower taxes. So that's, I think, what you have to plan for, is taxes are going to go up sometimes and they're going to go down other times. And you want to be in a position where you can take advantage and position yourself well to win in all scenarios.
I like it. And we got a chart here. U.S. top tax rate going back from 1970 to 2025. So 70% at the highest marginal bracket. Yikes. 1970, Reagan cut that down to 28%. And then you can see just bump, up, down, up, down, up, down. And we know we're at now the highest marginal tax bracket, 37% here, with President Trump down from 39.6.
Yeah, one thing you have to look at with that chart, and I've seen that for many years, is if you go back to the 1970s, for example, no one paid 70% because they had so many deductions, so many loopholes that they did away with. So it's not exactly an apples to apples comparison, because your tax rate also depends on your deductions and all those other things.
Yep. Good point. All right. Well, let's talk through some of these different retirement types of buckets. And I think that for entrepreneurs who are, $200,000, $300,000, $400,000, $500,000 of profit, smaller businesses or no employees, these things are just so magnificent as a tax planning tool, because they're very easy to set up. You can defer and get huge deductions up to $70,000 if you're under the age of 50 years old here through a SEP IRA.
We're about to go into some of these specific ones, right?
Yeah.
Before we do that, just a couple things on why from a planning perspective.
Yep.
So as we just said, like, tax brackets go up and down, and you want to have your investments in different taxable vehicles, meaning they're taxed in different ways according to the government. Why? Because if I have no money in a tax deferred account and tax brackets go down, I can't pull extra from that account to pay in that lower tax bracket.
Yep.
And if I don't have any money outside of something like a 401k, because you would never want to retire and just have all your money in a 401k, then rates go up, all my money comes out of my 401k, I have to pay ordinary income at the highest rate. So having money in different kinds of buckets allows me to piece together my income based on the tax rates that year and get the best outcome for me. So that's what we're after. The other thing a lot of entrepreneurs forget or don't know about this is retirement plans have some of the best asset protection of anything you can put your money in.
Yep.
And not to get controversial, because we won't, but a good example of the asset protection is O.J. Simpson had a judgment against him that kept accruing interest. It was like 60, 70, $80 million. And the victims could never get a payout because all his money was from NFL pension and NFL 401k. The retirement plans have incredibly strong asset protection. So I'm not saying you should go out and kill someone to test it, but I'm just saying there's a lot of great asset protection in these vehicles. And by the way, I don't have most of my money in retirement plans, but I have some of my money in retirement plans, and I love the asset protection. I love the fact that I'm diversified so I can pull from different vehicles when I start needing to have income, once you kick me out of the company or whatever.
Yeah, another big piece I think that a lot of entrepreneurs fail to grasp is just like the math. So if you're making over $1 million a year right now, you're in the highest marginal tax bracket. That's 37%. Let's just ignore any states. Well, let's just assume that you want to spend $30,000 a month when you're financially free. So you sell your business, you have your liquidity event, or you just harvest enough, you shut your business down. You're now living off of your passive income. Well, if you spend $30,000 a month, and let's assume that's all ordinary income, which is probably very unlikely, that's $360,000 a year, you're in the 24% tax bracket. So granted, tax brackets can and will change in the future, but if someone said, do you want to save 37 cents today to pay 24 cents in the future? I would say yes, because not only do I have the arbitrage between 37, getting the deduction today, and paying 24 in the future, I'm paying that 24% with dollars in the future. So I get to grow and compound that money over whatever amount of years, 5, 10, 15, 20, 30 years. So for me, it's also the compelling math. Yes, there's the variable of you don't know if brackets are going to go up or down, but the same other side of the argument is that they can only go up. But what if they went down? Then all these people who are banking on they can only go up, which if you've looked at the chart, they haven't really just gone up to the right. You're underwater in a lot of this. So there's two sides to every story, and I agree. It's just not the people who say everyone needs to put all your money in a retirement account. I don't think that's true.
No.
The people who say if anyone has any money in a retirement account, you're an idiot. I don't think that's true too. I think the truth is always a little bit more nuanced here, and I think it does fit in every single entrepreneur's, like you said, a diversified tax bucket and creditor protected bucket is how it should be thought of.
Yeah, the other thing too is it's forced savings.
Yep.
So
like a
I
mortgage.
never in my life have thought about going to my 401k and pulling money out for any ridiculous reason, but I've taken money out of other accounts. So it's also a forced savings, protects me from myself. But I like having money in different places and not all in one place, and different tax treatments from where the different money is. And I think that's the winning game for building wealth.
Yeah. All right. So if you're kind of, again, running a business, maybe you have $200,000, $300,000, $500,000 or so of profit, maybe not a whole lot of employees or no employees. No employees, a solo 401k is great. You can do a Roth solo 401k. You can defer some of your compensation or your W-2 into there. You can also do an employer match, which is your own business. SEP IRA, also wonderful. Now, once you start having employees, though, and those employees are sticking around for more than a few years, those vehicles become a little bit more challenging because there's anti-abuse. The IRS and the Department of Labor want to make sure that just business owners aren't putting money into these buckets and not the employees. So that's why I kind of say if you have employees, it becomes a little bit more muddied. I'd say that once you start having employees, you need to look at this more as a talent acquisition tool when we're talking about like kind of the simpler 401ks. Like within our business, we've got a 401k account. We do a safe harbor match, which means that if our employees get a 100% match on the first 3% that they put in of their own money, and then they get a 50% match on the next 2%. So if they put in 5% of their salary, we give them 4%. Now, we're allowed to put money into the 401k too, but it's costing us hundreds of thousands of dollars a year. So we're not saving money for taxes, but we want to attract and retain the best talent. So it's pivoted from like a quote unquote tax vehicle to a employee retention and attraction vehicle.
And I'll give a shout out for Do Well for our own company, because we've helped a lot of entrepreneurs do ESOPs over the years like ours. And I have to tell you that we're one of the few that I've been a part of where we still do a match after the ESOP. Because a lot of the business owners I've worked with, they're getting the ESOP stock. They don't also need a match on their 401k. So it's pretty generous. We're pretty nice guys.
Yeah, I like that. I like thinking to myself as a nice guy.
Feel good. It's a good feel good thing for both of us. I just threw that out there.
All right. So then for most of our entrepreneur clients, maybe you have that 401k plan in place. Again, it's more so just so you can attract and retain the best talent. You're making over $1 million a year of take home. You're a successful entrepreneur, or much more than that. Then the plan that could potentially make sense is stacking a cash balance plan. And so this is only really kind of works with entrepreneurs that are getting paid high W-2 relative to their employees. So if you have a bunch of high paid employees, then the cash balance plan may not make sense. And also if preferably you're a little bit older than your general employee, these cash balance plan when stacked with 401k plans can allow you to put hundreds and hundreds of thousands of dollars away and in an actual retirement vehicle for you as the entrepreneur. And what makes these so powerful is that when you shut down that cash balance plan, you can roll the amount into your IRA. So it's not like one of these pensions that, GE and Ford and all those companies used to have, where you have to kind of pay yourself out $3,000 or $4,000 a month. Yes, that's how the benefits are calculated on this, but it's actually a lump sum of money that you can then roll over when you shut your cash balance plan down or you sell your business. Private equity or strategic's not going to want to deal with this. So what are your thoughts on cash balance plans? And then let's go through an example.
Yeah, I really like cash balance plans. And of course, this is where you need some expertise and someone who does retirement plans like this to run some calculations so you see how it benefits you, because it does depend on your W-2, it depends on your age and those types of things. But I like cash balance plans, and I see a lot of clients who like them too.
Yep. All right. So let's now transition, Jim, into a real case study here from our fractional family office. So 2 entrepreneurs, business owners here, co-business owners, they were able to put over $1.4 million into a 401k cash balance combination. 1.2 of that 1.4 went into their actual accounts.
Wow.
Pretty powerful.
That's a lot.
Deferred $520,007 of taxes.
It's incredible.
That's a good deferral.
Yeah.
So service-based company, over $4 million of total payroll. These entrepreneurs were a little bit older than their employees. They were higher paid W-2. They're the business owners, so of course they can throttle their W-2 up and down. So intentionally we would throttle their W-2 up, pay a little bit more in Medicare taxes there. But that's because we could get massive deductions through the cash balance plan. So how does this stack up? So the cash balance plan was $1.1 million. That's how much was dumped in there. They also got $63,000 of their own money in deferrals from 401ks because they put their own money into their 401k. They did just under $40,000 of 401k profit sharing, all into their account. So again, their cash balance account, their 401k account. So that was $1.2 million that went into their buckets. Now, what did they put into the employees? $211,799 went into the 401k matches and profit share. So all in, $1,418,201 was the total deduction amount. 86% of that going to the entrepreneurs.
Yeah, pretty incredible numbers. Just something I want to throw out there is, because a lot of entrepreneurs get given the idea of doing self-directed.
Yeah, love it.
What can you do in self-directed as far as these types of plans? When would that apply? When wouldn't that apply?
Yeah, so you got to look in there's something called a TPA, a third-party administrator. They're the ones who put these plans together. They put together the 50-page document, help file your 5,500, with the government, all that kind of stuff. You want them to put it in something called in-service distribution. And so an in-service distribution allows employees, of which, our business owners would be an employee if it's an S corporation, to pull money from a cash balance plan and move it into a self-directed account. So it's possible, but you have to have specific language in your documents. And then if you move it into a self-directed account, it unlocks crypto, private equity, venture capital, all of these different asset classes that you can hold, even in, investing in like kind of small companies that you can hold, which you can't invest within the normal cash balance or 401k structure.
Yeah, or real estate too.
Yeah.
One thing I'll say about that is that can be a great opportunity, and that can also be an opportunity for you to wreck yourself if you don't know what you're doing and you roll the money out and put it in a bunch of things like private equity if you don't know how to invest in that area. The other thing is, when it comes to real estate, I don't know how you feel about this, Bryce, but to me, I always like real estate not in an IRA.
Totally agree.
Because you get all the tax benefits, the depreciation, everything else that makes real estate so great. So the only time I would say use a self-directed IRA for real estate personally is if you don't have any other money and you want to invest in real estate, and that's an asset class that you need. Because if you have a choice, I always like real estate not in an IRA or a self-directed type of plan.
Yeah, self-directed is also great for like any type of hedge fund. Anytime they're doing a bunch of trading, they're realizing a bunch of taxes. Like that always is great to hold in self-directed. And private credit. If you're getting that 8, 9, 10, 11, 12%, and if you don't need the cash, you're just letting it stack and grow and compound, putting that in a self-directed IRA is a beautiful thing. Yeah. But I'm with you. Real estate, especially if you want to do like cash out refis, all this kind of stuff, you don't have to deal with the self-dealing because you have to deal with very stringent self-dealing rules. If you're trying to do any improvements, and technically you can't guarantee any mortgage in a self-directed IRA. So there's a lot of issues of owning real estate directly in a self-directed IRA. But if you
think about that, let's say you built up a Roth 401k, and then you rolled that to an IRA, and then you put that in private credit, you could get 9, 10, 11, 12% off your private credit completely tax-free as, income during retirement or something like that. And I shouldn't say retirement. Income during your financial freedom years. That's probably better because I never think of retirement. No one wants to retire.
No one wants to retire.
Sounds like you
keep going.
Get a watch and you die in 5 years.
Take a sabbatical, reload, do it again.
Yeah.
So closing back to this client again, saving or really deferring over $500,000 of taxes. Well, what was the whole play here? Well, this client was in by far obviously the highest marginal tax bracket, and so they wanted to mitigate their tax bill, and also based off of the projections and the lifestyle of this client, the expectation is they're probably going to move to the 24 to 32% tax bracket after they sell their business, based off of kind of how their balance sheet is set up and when they're pulling money out. So why not get a deduction today at 37%, let that money grow and compound for over 15 years until eventually the IRS will force you to pull money out of these retirement plans through an RMD at starting at age 75. But again, get a deduction today at 39.5, or really when you include state here, 37% federal, pull it out at 24, 32%. So I'm arbitraging the difference and let that money grow and compound tax deferred for 15 years.
Yeah, makes total sense.
All right. So cash balance plans, again, got to be the right fact pattern, but it can make a huge impact. So let's wrap up here with from the Fractional Family Office floor. We're excited to announce we're putting the final touches on a book, Billionaire Wealth Strategies for Entrepreneurs. So this is going to be pretty cool, a guide for how entrepreneurs can build their own fractional family office, tons of tactics, strategies, no secrets being left out of this one.
This book is so chock full of stuff. I almost feel like we put too much in here because it is a lot. Like we threw the kitchen sink in here and everything else. However, this is a book that you don't have to read it page by page the whole way through. You can pick sections if you want to go to the tax section or the asset protection section, or any of the different sections that are most important to you. But yeah, you could take this book and you could build your own fractional family office just from this book.
Yeah, it's gonna be great, and we're gonna give it away for free. And so, I mean, it's gonna be available on Amazon and Spotify and all that stuff, of course. And I think on Amazon, I think we have to charge like $4.99 or something like that's the minimum. But dowealth.com/book. It's going to be right there. It's going to be the audio version. They can listen to it for free. There's going to be a flip book all in there. So if anyone wants to check it out, dowealth.com/book. We're doing this because we want this information out. So we're doing a podcast. We're just trying to continue to educate entrepreneurs, help them stack awesome strategies, use strategies like the cash balance to defer, mitigate taxes, and to really make rich real. That's what this is all about.
Yeah, I love it. Yeah, I'm excited, and really tribute to you to do. You did a lot of the work on this book. I'll just be honest. I'll take as much credit as possible, but you did a lot of the work, and I appreciate that. But this is really 30 years of accumulated intelligence and knowledge about entrepreneurs and what they need. And you and I have seen it. There's such this empty space in the world. You've got traditional financial advisors that have clients from all walks of life that really don't have the specialty in entrepreneurs. And then you've got these like financial coaches and people who are, or insurance salesmen who are coming in at the entrepreneurs at a different direction. And this is really the family office structure and really what every entrepreneur needs to know when it comes to, as we said earlier in this call, like building real wealth.
Yeah, I love it. Well, we're going to wrap up here. Biggest takeaway. Sounds like you may have just given me your biggest takeaway from this episode.
That is.
I think for me, I'll go with the kind of, I love our retirement conversation there. Retirement plan contributions and massive tax deferrals there. I think too many entrepreneurs are just like, nah, I don't do that stuff. Like, that's not for me. But I think that it makes tons of sense. And I do think it fits into pretty much every single entrepreneur's tax diversification bucket. I think they just sometimes want to zig too much when everyone else is zagging. Yeah. And I think that, entrepreneurs need to open their eyes a little bit sometimes to some of these strategies, and allocating some capital to these types of diversified tax buckets generally makes a lot of sense.
Yeah, it almost sounds controversial, like to say retirement plans can be smart.
Yeah.
And I think part of it is, and I know this as being an entrepreneur for most of my life, is like you don't want to do anything traditional. And that sounds traditional.
Yeah.
And it is. But it also makes sense in an overall plan. It doesn't mean that you need to go to the traditional route on everything like you're a 70-year-old retired person. But this does have its place for business owners. It's got great asset protection. It's a good diversifier. And it prepares you for a better tax outcome when you actually start pulling money out.
Well said. Thank you, Jim. And good to see you.
Yeah, nice to see you, Bryce.
Thanks for listening to Make Rich Real, where million-dollar businesses meet billionaire strategies. Please note the following disclosure. This podcast is provided by Dew Wealth Management, an SEC-registered investment advisor. Registration with the SEC does not imply a certain level of skill or training. The information presented in this podcast is for educational and informational purposes only and should not be construed as personalized investment advice, tax advice, or legal advice, or a recommendation to buy or sell any security. Nothing discussed in this podcast constitutes a solicitation or offer to provide investment advisory services to any person in any jurisdiction where such solicitation or offer would be unlawful under the securities law of such jurisdiction. All information presented is believed to be reliable, but is not guaranteed for accuracy or completeness. All investing involves risk, including the potential loss of principal. Past performance, if mentioned, is not indicative of future results, and no investment strategy can guarantee profit or loss. Any mention of specific securities, investment strategies, or market performances for illustrative purposes only and should not be considered a recommendation. Economic and market conditions are subject to change, and any opinions expressed are currently only as of the date of this recording. Before making any investment decisions, please consult with a qualified financial professional who can assess your individual circumstances, risk tolerance, and investment objectives. For more information about our services and fees, please refer to our ADV Part 2A, which is available at our website, dowealth.com, or upon request.